the first thing that I always see is whenever an analyst asks about capital allocation, they mean dividends, paying down debt, or buying back stock.
Yes.
And I just sit there and think, it doesn't start there. It starts with revenue.
Yes.
And then what are you spending that money on
Yes.
to get more efficient or whatever it is? And this is ad nauseum.
Uh-huh.
And so some of the CEOs and CFOs of, Fortune 50s that I've gotten to talk to, you can find out pretty quick if they understand this or not.
Uh-huh.
Because when I start asking about capital allocation and they go right to buybacks or right to increasing the dividend, all I think is, are you really thinking about this properly? So to me, the biggest ones is that people just don't understand that this starts much earlier with improving operations, maybe not spending marketing dollars on campaigns that really don't generate much of a return. The reason I bring that one up, I was literally I'm analyzing a company right now. It's a turnaround situation where they're talking about exactly this. They're saying we've been spending money on marketing campaigns that just aren't doing anything. And it's like, well, then we're throwing money down a black hole for no reason. It's all aspects of the business. I mean, in this case, they're frontline workers. They needed to increase salaries, so they stopped leaving because turnover is expensive. So there's so many ways to think about this, but people never seem to ask the questions from the operational side of the business, which is arguably what's going to make the business great or not.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question, what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil Baranowski, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable quality businesses, while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on the show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. I'm laughing already. Well, my guest today is Kevin Koharki. He is an MBA PhD, founder of CAE Consulting, associate professor at Purdue University. He has spent 20 years analyzing hundreds of firms and believes that every employee, not just the executives, should understand how their daily decisions impact capital allocation and long-term value creation. Kevin, how are you? So nice to see you again.
No, very, very well. Thanks for having me, Bogumil. I'm doing quite well.
I'm very excited for this conversation. You and I met at Guy Spears Value X in Clusters. Guy is a wonderful person. He has a way of attracting bright, kind, generous people into his life, which I think is a gift. So I'm very grateful to have him in my life and all the people I met through him, including yourself. I got to see you in Omaha in passing as well, which was nice. We talked quite a bit a month or two ago, and I learned quite a bit about what you do. But I have so many more questions, which I saved for today. So let's do it. Perfect. I want to start from the early days, if you indulge me. And I like to ask my guests about their childhood upbringing. And how do you think that time shaped you? I do want to ask about the relationship with money and the career path that you chose.
Yeah, childhood. I mean, I didn't know three of my grandparents because they died when I was too young. So I really got to know my father's mother very well. She lived into her mid 90s, which was my mid 20s, and her and I were just very close. And so she was a Depression era baby and all that stuff, and she really shaped my views on a lot of things. Just hard work, discipline, save your money. And so it was a fun upbringing. Her and we got to live very close to each other for a period. And I just spent a lot of times with her watching Yankee games, going fishing, and doing all that stuff. So I was fortunate that I was able to be close to her and my father and my uncle. And so it was a good group of people that taught me a lot of the values that I have today.
Well, I love the sound of it. And I have to tell you, you might be surprised or not, how many grandma stories I've heard. And I also shared my grandma's story. And, I manage money for wealthy families these days, but I look back at the principles that I apply every day. And yes, I read about them in investment books, but it was my grandma that took me grocery shopping and showed me what price and value mean to her, and how it's not about buying the cheapest thing, but looking at the quality of what you're putting in the basket. And she might have not known at the time, but she was shaping a future value investor here.
Yep.
So that really rhymes with me. I'm very curious how you found yourself in the career work and research that you do these days. How did you find your way to this field?
I mean, I remember it clearly. It was 1999. I was working for my father at Johnson & Johnson. My whole family worked there. We have over 100 years at that company. And I knew I was going to college. I didn't want to do supply chain like him. Nothing against it. It's just I knew it wasn't for me. I'm more of a numbers guy. And so I thought accounting could be cool, this and that. But at that time, there was a book called Rich Dad, Poor Dad by Robert Kiyosaki, which was huge at that book was huge at that time. So I read it and I loved his message, but I didn't think real estate was for me. I mean, I didn't know, but it didn't jump off the page. So after I read the book, I devoured that book, and I did not like to read. I looked in the back, and in the back of the book was Peter Lynch's One Up on Wall Street as part of his recommendations. It was actually Beating the Street. And so I went to a company that doesn't exist anymore called Borders. They were like Barnes and Noble.
Great place.
I found One Up on Wall Street and Beating the Street, realized One Up on Wall Street came first. I read that book, and that was like getting hit by lightning. And as they say, that was it. I read that book and realized I don't care what I do, I have to do investing in common stocks. And it just went from there. So, like a lot of people, you start to read anything you can get your hands on, and always heard of Warren Buffett, didn't know much about him. And then after Peter Lynch, and, he said in that book that I know Buffett called him at one point because he wanted to use one of his quotes in his annual letters. And that just set off the firestorm.
So many questions. And you might know that I picked up One Up on Wall Street in college in an English language bookstore in Brussels, where I was a student at the time. And I loved history, political science, economics, business, but I couldn't really imagine how I'm going to use this. It was just fascination and curiosity. And then I'm picking up this book, and he tells me that I can buy small pieces of businesses. And to this day, this is the biggest revelation. Maybe obvious to you and I and this audience today, but to this 20-year-old kid that picked up that book, this was, wait a second, I don't have to be the richest person in the world. I can become a shareholder in so many wonderful businesses that other people are running for my benefit. Blew my mind. I never looked back. I do want to ask you about how you teach people about finance and money. But before that, just for the benefit of the audience, how would you describe what you do? You're teaching, you're researching, you're consulting. Like, what's the gist of it all? What's your passion and curiosity?
Yeah, my passion has always been about it's more practical. I mean, I taught accounting for a while, not necessarily out of a textbook. I mean, you do the debits and credits, and that's fine. But the way I always teach is more applied. So I was designed, I think, to teach financial statement analysis, and that's all I teach now. I teach it for graduate students. And I do it the way, at least I think I do it the way that Ben Graham taught Buffett, where I literally walk in and just drop a 10K on their desk for a company that I'm thinking of investing in or maybe already have.
Yeah.
And I just say, guys, if you want to learn how to hit a curveball, you have to step in the batter's box. You can go read Ted Williams' excellent book on hitting, but you have to see the pitch. You have to go through it and play the game and everything else. So I don't even use a textbook because, in full disclosure, I don't think most of them are written that well. There's things that they completely ignore that I can't believe get ignored, but professional analysts ignore them, so it's fine. And that's essentially at the college level how I do it. In my consulting practice, I'm really teaching people it doesn't matter their role. It doesn't matter if they're sales or R&D or HR. I'm basically teaching them the financial value of their work and how to communicate that up the ladder. I fell into this by accident with a couple of very large clients, and I absolutely love doing it. And I've realized that there's just not a lot of people who understand how their roles really impact the financial statements, but more importantly, how they impact the CEO's capital allocation decisions and just overall perspective. And I found that once people understand this, not only do companies perform better, but people as a whole, they kind of find their purpose more. And I'll tell you a quick story. I'm working with this company. They're $84 billion in revenue. They're a huge defense contractor. And this guy comes up to me and he goes, my dad worked here 35 years. I've worked here 36 years. And now my two sons work here. And it's essentially the same job out of Connecticut. They're engineers. And he goes, until you showed me what you showed me, I never realized that this is what my job was actually doing. He goes, 71 years of collective experience. We never knew that this is what the job really entailed. That just lights me up.
This is so incredible. When I'm thinking, as an investor, I see myself as a business owner, right? And then when I think of business operators, and I had a conversation with someone the other day, how the business owner is so busy with just making sure that the business runs, the customers are happy, the suppliers have everything on time, the bills are paid. They're so busy just running the whole thing. They might not even know what the stock price is of their company, unless it's a CEO that's compensated based on that.
Oh, yeah.
Right? So they don't really have the time. And then you have to sit down with them and say, all that you're doing, that translates to this kind of unit economics reality, and on and on and on. And then they think, oh, wow, so this customer is more valuable. That customer is just taking up my time. And they start to think about it in a different way.
Yep.
I have to tell you, how many times I've heard that people told me, I'm just not good with money. And then they start asking questions about money, and they don't give themselves credit how much they intuitively understand. And maybe it's the walk with the grandpa or grandma back in the day that taught them things. But I think some of us are just intimidated by numbers. Maybe you and I are not, but many of us are. How do you go about explaining money, finance to people that feel the minute they see numbers in front of them, they faint or they run?
Yeah, I'll tell you, God, I've been doing this for like 17 years now. Sometimes it depends on the person. I don't run into too many that are so frightened that they can't handle it. But for the ones that you could tell are just, they're relatively scared, you have to start at the basics. And I start asking them questions about where they want to be in 20 years, 30 years, basically when they're older. Do they want to retire and all this other stuff? And maybe I'm too blunt, but I basically tell them, look, if you don't start to get a handle on this stuff, if you don't start to understand it and adopt some of these principles that you need to apply to set yourself up for future success, it's never going to happen. And so the story I always like to tell them is, if you want to be the Walmart greeter at 80 years old, that's fine, but do it because you want to, not because you have to. So part of it maybe scare them a little bit, but for the most part, I've honestly found that most people, they've just never really sat down and done the math. So I have something I always tell when I used to teach undergraduates, but my graduate students, I say on my tombstone, it's going to say three words: do the math. And it's most people just don't sit there and do it. And I'll give you a quick story. So when I was 13 years old, my father and I are ski nuts. We love to ski. And our goal from New Jersey, so not anywhere out west where the skiing is a lot better. our goal was to go to Vermont, and we were going to drive. Weren't even going to fly. So this is not an expensive trip. But for my father, you know, he was a single earning household. My mom was a stay-at-home mom, which was terrific. But I came home one night, and he looked miserable. He was sitting at the kitchen table. I said, "What's wrong, Pop?" And he goes, "I'm putting this budget together, and I realize we're not going to be able to go skiing for like 2 years just because I got to budget it out." And he told me, he said, he goes, "Kev, I'm going to tell you right now, I don't care what you do with your life. 2 things. Make a lot of money and make sure it's legal." So I never forgot that. So I've always adhered to that. As far as I know, I've never done anything illegal. But it was at that moment that I thought everybody was doing what he was doing. He ran a budget. And then when I was 15 and I was working at this food store in New Jersey that everybody from New Jersey would know, I'm hanging out with these guys during lunch, and I bring up budgets because I'm dumb enough to think everybody has one. And then I realized nobody has one.
Yeah.
And that is still true. So when I teach adults or students or whatever they are, I find that most people just don't sit down and do the math. And I think it's for the reasons you're saying. I think they're afraid of it. But once you really walk them through what a budget is, and they realize, oh, this is 2nd, 3rd grade math. I said, yeah, at most. It's not complicated. You just have to put in time. That tends to calm them down a little bit. I think the big problem is people don't want to have the realization that, oh God, I'm spending all this money on maybe silly things that they don't necessarily need. And goes back to my grandmother. My grandmother, this is the 90s, keep in mind. So like cable TV was the big thing. She always had this saying, if you will, it's just a question. My wife still does it. She'll just say, "Got cable?" In other words, to my grandmother, if you had cable TV and you were complaining about money problems, you didn't have money problems because you don't need cable TV. Like that, to her, was the most discretionary luxury thing possible. So her thing was just, well, call me and tell me what your problems are after you've cut cable. And if you haven't done that, you haven't made the sacrifice.
You're fine.
So that to me is where in the budget, people, I think they're afraid to realize, like they know that there's things that they probably shouldn't be spending money on. And if somebody points it out, I think that's the scariest part is, oh, I might have to do without some of these things. But that's part of it. It's taking the medicine of showing them like, hey, you might have to make some cuts here or there, but the math is 2nd grade math.
What's incredible about the work that you do from the conversations we've had is that you have that picture of a personal budget, household budget, and then you go all the way big, and we'll talk more about it. The CEO of a company, capital allocation, and all the things related to it. You say that capital allocation is the most important job the CEO can have, but you say that it's not only the CEO's responsibility, it's also the responsibility of everybody else working for the company. Tell me how you think about it.
So first I have to make a slight correction because I can't take credit. As you know, Warren Buffett wrote that capital allocation is the CEO's number one responsibility in his 1987 letter. I think that was the first time he really talked about it. And so I read his letters when I was like 25. I went through them. And Bogan, honest to God story, I'll swear on my life for this. My wife and I are going out to Vegas in 22. It's the first time we've ever been. She has a company thing out there, and we're like, all right, let's just go out there and make a couple days out of it, see what the big deal is. On the flight out there, I'm rereading the annual letters. So this is whatever it was, 15 years later. And I'm rereading all of this. And this was like the second time I got hit in my life by lightning, so to speak. It all just clicked. Like I really understood what the heck he was trying to say in those letters. And then it dawned on me. And this was about the same time that I just fell into this big defense contractor by accident. It had all clicked, and I realized people don't understand this. They don't understand that they have budgets at corporations. Like my father was supply chain. He had a budget. Yeah. In other words, the CEO is responsible to allocate capital, but he or she can't do it alone. That's why you give a budget to marketing. That's why you give a budget to R&D. So they go do their part. But people don't train employees to think about it that way. And so to me, it was clear as day. I was just sitting there thinking, oh my God, these are the stories I've been hearing from employees ad nauseum for years. I don't know what to do with this. How do I make a case for that? And it just kind of clicked, and I realized these people need to start learning this. And lo and behold, like 5 months later, I start working with this company, and it just went from there. So it was dumb luck on timing, I think. But it was a lifetime. It was 15 years of studying investing, learning all these metrics and the calculations and thinking about things, and it just kind of all clicked. So I always tell people, like, that you said it earlier, Buffett's correct when he said, I'm a better businessman because I'm an investor. I'm a better investor because I'm a businessman. The two go hand in hand. And that kind of applies here, I think.
Very much so. I like that dimension that we think of the CEO sitting there with the CFO and allocating the capital and the job is done. It's not. It's really just the beginning, right? Because then it has to be actually a two-way street in many ways, right? All the way from the bottom, somebody standing there saying, I need a new pair of shoes or I need a new truck for this delivery route. And it goes all the way up the chain. Yes, there's room in our logistics department for another truck that goes up to the CEO. And then we actually need 50 of those, right? And then the order goes out. So it's a two-way street. It's not like you have this incredible unlimited authority at the top that you know exactly what everybody needs and you can just decide for them. It's a beautiful way of thinking about it. And the more efficient that flow of information and feedback is, I think the better the business can run. And speaking of Buffett, I mean, I think he runs his operation with a very tiny team out of Omaha, and he allows every business that he owns run the show on their own and just make a phone call when it's a larger amount that they need. And I think and ideally if they keep on sending unneeded cash to the headquarters so he can invest, that's a part of it. There are some big misconceptions about how we should allocate capital, how business leaders should allocate capital. What are they?
Oh man, I'll tell you. So I see this with the sell side analysts quite a bit because, I mean, I'm easily looking at, I don't know, 50 companies a year, maybe more, reading hundreds of conference call transcripts. The first thing that I always see is whenever an analyst asks about capital allocation, they mean dividends, paying down debt, or buying back stock.
Yes.
And I just sit there and think, it doesn't start there. It starts with revenue.
Yes.
And then what are you spending that money on?
Yes.
To get more efficient or whatever it is. And this is ad nauseum. And so some of the CEOs and CFOs of, Fortune 50s that I've gotten to talk to, you can find out pretty quick if they understand this or not. Because when I start asking about capital allocation and they go right to buybacks or right to increasing the dividend, all I think is, are you really thinking about this properly? So to me, the biggest ones is that people just don't understand that this starts much earlier with improving operations, maybe not spending marketing dollars on campaigns that really don't generate much of a return. The reason I bring that one up, I was literally I'm analyzing a company right now. It's a turnaround situation where they're talking about exactly this. They're saying we've been spending money on marketing campaigns that just aren't doing anything. And it's like, well, then we're throwing money down a black hole for no reason. It's all aspects of the business. I mean, in this case, they're frontline workers. They needed to increase salaries, so they stopped leaving because turnover is expensive. So there's so many ways to think about this, but people never seem to ask the questions from the operational side of the business, which is arguably what's going to make the business great or not.
No, it's fascinating how that works, and I agree with you. When I listen to those earnings calls and the questions that the CEO receives, it's basically, what can you do for me in the short term to move the stock price or give me the money with a special dividend? And well, how did this money come about? And is there a better use of it? I had James Emanuel on the show who wrote The Fabric of Success and analyzed a lot of businesses. And one thought he left me with, which I found really intriguing. I'm curious what you think about it. But he says that for his own needs, he wants businesses that cannot pay a dividend because they have so many ideas how to use the capital internally at a very respectable rate of return. And that it's just too many ideas, too little capital. They're not there in a position to pay a dividend in a good way. And I thought, wow, I don't remember the last time somebody presented it to me that way. Don't you want a business like that continues to reinvest and has just more ideas what to do with the money at a really good rate?
It's I'll tell you, over the years, right? I mean, you tend to change your mindset as an investor a little bit. I know I certainly have. And one of the things that I've really taken to heart, I'm going to say over the last 3 years, is when Charlie Munger talks about literally, you need maybe 3 investments in your lifetime. I don't remember what speech he talked about that, but he's mentioned that. And I when I read that years ago, I thought, 3? How do you do that? And then you start to realize it is concentration, but you very quickly realize there just aren't that many great businesses out there that could take their capital and reinvest at high rates for a long period of time. And so it makes sense that when you find one, you go very heavy into it. It's exactly, in my mind, what you're saying is we're constantly on the hunt to find those businesses. And when you're lucky enough to find one, I don't know why you would try to own 50 companies, so to speak, right? I mean, you know, considering the size of the portfolio, obviously, if you're, you know, a couple billion in management, that's a different story. But all things considered, you really just should be looking for your best ones. And it's really difficult to find a company that can compound at a high rate for a long period of time. So in that case, yeah, why would I want them paying a dividend? I mean, I'm right there with you. It's just, it takes a lot of guts to do nothing for years. And that's whatever this speech was that I can't remember the date of it. He talked about that. He said, it might be 5 years, might be 10 years, and you just do nothing. You just keep looking and you keep looking. And sooner or later, the market has a hemorrhage, and, you know, then you do your thing.
Yeah, it made me think differently. I mean, it will come up in this conversation a lot, but when you look at the statements, they're showing you the past, what the business has done. And we're obviously hoping we can extrapolate some of this success into the future. But what we should be really asking for, what I'm hearing, is what are you going to do next with the cash that will come this year, next year, in 5 years and 10 years? What's your plan? What are your ideas? What to do with it, right? And if a company is doing heavy buybacks and increasing a dividend, I think it's an obvious sign that on one hand is giving in to the pressure, obviously, from the short-term focused shareholder. On the other hand, it means that if they don't have great ideas anymore, I think that's the source of, you know, worry. Yes, you can calculate the ratios and show me, you know, the returns are so high, but that's based on the past. What about the incremental dollar that you're putting to work? Are you getting anything close to that?
Yep.
I have some doubts, you know, like that's that's how I think about it. I'm curious about a healthy culture around capital allocation. What you've seen, what you've researched. How would it look like to say this is the way it should work?
This is all right. This is a good question. This is a really hard question. So what I've seen, and I'm going to think of a client that I have, they are, especially under current leadership, there's been a change over the last couple of years. They are very, very good at distilling down, or at least they're getting better at distilling down throughout the organization the importance of this. Now, you said the magic word. You said culture. I don't care what size the company is. You don't change culture overnight. It's going to take years. And in a lot of ways, this is what I help them with. So I'll come in and I'll do my training, but I always have to tell them, guys, this is not something that we can turn on a dime. So we are changing mindsets, just like when I'm talking to my master students or whatever it is. And I'll take a day and I'll go through what a 401k is, an IRA, and some of the tricks and all this other stuff that they can use, for lack of a better word, legal tricks, mind you. And they'll come up to me afterwards and they'll say, man, I never heard this. I never thought of it this way. And it's part of a mindset shift. And so to me, the best companies that I've had the privilege of working with, they know this is going to take time.
Right.
But you got to start somewhere. You hopefully bring in the right people who can kind of develop that, whether that be external consultants or most likely, you know, C-suite executives, obviously. And then it's just constant. It can't be something where it's like, well, we did this at an offsite one time. No, it has to be, we started with an offsite. We told them what we were going to do, and then we changed our disclosure requirements. And so now we have regular town halls with our employees where we go through this stuff over and over again. I have not found a company that can do it once or twice and that's it. It has to be constant. Somebody told me a long time ago, you know, the reason diets never work is because sooner or later you get down to your target weight and you quit. And if you go right back to what made you overweight.
Yeah.
So, right. the point is, what they also told me was, if you want something to stick as far as weight loss or whatever it is, you have to change the way you think about food and exercise. In my mind, capital allocation is the same thing. You have to change the way you think about it, which by definition, you're changing the culture at that point. Because if you say, hey, we're not just going to throw money on bad projects anymore. We used to do that, but we don't do it anymore. That's what you have to do. This is all about changing mindsets, and it's part training, and then it's part keeping up, whether it's every 6 months, 3 months, whatever it is. Go back through the metrics, reiterate the goals, because it's going to take a while for some employees to really adopt these new policies and ways of doing things. But if you keep kind of hitting them over the head, for lack of a better phrase, they'll get there sooner or later. But it's got to be consistent.
It's not a single decision or a single, meeting or event or training. It's something that has to become part of the DNA.
Yep.
And I mean, for lack of a better example in this moment, but Berkshire, no endorsement of any kind, just a case study, an incredible company that created this culture of, respecting the capital and how do you put it to work, all the way down to the smallest business they own, all the way to the top. And it took decades, and we can all, watch, learn from it and aspire. But other businesses could learn from it. By the way, a company doesn't pay a dividend.
Yeah, exactly. Well, you said Berkshire. I was going to say another one, which of course not an endorsement by any stretch of the imagination. It's just true. But the mini Berkshire, if you will, as they're called, Markel.
Yes.
They do the same thing, right? You read their annual reports, whether it's Berkshire or Markel, and they'll flat out say, look, if we're trying to underwrite and we don't think it's profitable, we do not underwrite the business. And you just think, it really is in a lot of ways that simple. It's like, well, don't do this thinking you're going to incur a loss and hope the investment portfolio makes up for it. Like, why are we underwriting bad business? But as Buffett's been writing about for 50 years, that's largely how the insurance industry works.
I don't want to, sidetrack us too much, but you're touching on something fascinating, which a perfect case study for both companies, which happen to be insurance businesses with a float that's invested. And you have two kinds of discipline that you need on both sides. What's very unique about the insurance business is that there's actually no speed limit to how fast you grow. You could underwrite an incredible amount of business with no discipline whatsoever
Right.
and get in real trouble sooner than you think. And it's the same with a bank. You can give out loans to people that will never pay you back, just to make it more relatable for this audience. So you can grow the bank at the speed of light, as fast as you can issue loans, but those loans will never be paid back. So, you have to be very thoughtful about what kind of growth you want. And I think that discipline on the insurance side, or if you're running a bank as well, and then the investment side as well, the two coexist at Berkshire, at Markel. Buffett talks about about insurance as if it was easy, but it's actually a very, very tough business. And you're playing with the future and uncertainty, and you're underwriting a risk that you might not always have a full grasp of how it's going to play out. It's a tough business. He makes it sound like it's much easier than it is. I think it's really hard, but let's leave it at that. I find it fascinating. I'm curious about the kind of work you do. You do deep dives on the business that you analyze. How do you go about it? Where do you start?
I mean, I start the way most people start. I mean, obviously go through the 10K, the conference call transcripts, all that fun stuff. And then where I can, if I can get a hold of suppliers, customers, executives, things like that, I'll start to talk to folks. Now, what I found is, ever since I set up a website doing this, when I'm able to contact somebody at the company and say, hey, and this could be, anybody, head of engineering or whatever it is, and say, hey, do me a favor, go check out my website. I'd like to talk to you about the business, but here's an example of some of the stuff I'm going to ask you. So because they don't know me from Adam, obviously. So then they realize, oh, okay, this guy's an investor. I see what he's doing. He's not a reporter, or he's not trying to sandbag any of us or things like that. He's just trying to learn. That to me is where I start with my deep dive, if you will, because obviously it's hard to get people on the phone or what have you, especially when they have no idea who you are. Where I think a lot of other services are missing, and this is the second part that I get into the more quantitative, if you will. there are, to me, a shocking number of investors, analysts, whatever you want to call it, that they're not making the adjustments to the financial statements they need to make for various items. And one of the biggest ones, it sounds silly, but one of the biggest ones is just leases. Ever since we started putting leases on the balance sheet, people think, okay, well, that problem's taken care of. And I sit there and think, no, but the income statement and the cash flow statements haven't been adjusted. So if I'm comparing one company versus another, and one owns most of their real estate and the other one doesn't, they're not comparable. And that's a real example. Again, as you always say, Bougainville, not an endorsement by any stretch of the imagination. This is just literally what you read in their 10Ks. Walmart tends to lease most of their property, and for the longest time, Target owned most of their properties. So this is not a comparable property, plant, and equipment account, which means the depreciation and the EBITDAs are different. So it's just simple things like that. I mean, I won't say the name of the company, but there was a company I analyzed a couple of years ago, small company, European company. And I use this in my financial statement analysis course, and the analysts were all forecasting EBITDA. And then I would walk my class through it, and I would say, they're saying the EBITDA is positive. I'm saying it's negative. What is the difference? And they would look at it, and it was a software company. And they would look at it, and sooner or later, somebody in the class would figure it out, and they'd say, well, wait a minute, they capitalize their software costs. I said, of course, they're a software company. I said, so what's the problem? I said, what do we do with software? And they'd say, well, we amortize it when you capitalize it on the balance. I'd say, exactly. So I said, does it ever show up in EBITDA? And they would say, well, no. And I said, so think about it. Their biggest, most important expense doesn't show up as an expense in one of the main ways that we're trying to value the business. And the light bulbs, like people are sitting there like, oh my God, how is this possible? And I said, guys, remember, this isn't illegal. This is, in this case, IFRS, but it's US GAAP, whatever you want it to be. But I said, but the analyst needs to know to make these adjustments, and I can't find one that is. So part of it's the qualitative, where I'm trying to actually get a hold of vendors, customers, things like that. But the other part, honestly, I'm just looking at people not doing enough adjustments on the financials. And I rarely read them in a sell-side analyst report. They'll just go with whatever they say management's adjusted numbers are, and that's it. And I'm sitting there thinking, what about stock-based compensation? What about leases? What about pensions? I mean, for the longest time, GE, before it was broken up, again, not an endorsement, people would look at the cash flow and say, oh, the cash flow looks pretty good. And I'm sitting there thinking, not with that underfunded pension liability.
It doesn't.
So to me, it's just, it's almost like a collective amnesia with a lot of investors, where they're not doing the proper due diligence on the financials. And it scares me.
I think it's convenient to forget that there are 3 financial statements, right? And if you just look at one, and they do talk to each other, if you look at one, you might be missing, because it's like a triangle. 2 of them could be talking and the third one is not in the room. I mean, almost like that. But they do talk to each other, and you're right. You're depreciating or amortizing something, and it's skipping the EBITDA, but it's there, and something is happening, and economic activity is happening, and we should be figuring out a better way to capture it. Can you share your big picture thoughts about, and you and I talked about it, financial statements, how they came about? They're man-made. The double entry history, it's been a few hundred years. I think it was an Italian merchant, a bookkeeper, that invented it. It changed my life. I find it fascinating. It's such a simple concept, but it explains so much. But it's imperfect. It's human-made, and it's subject to continuous, evolution and change.
Yeah, no, I wish I could. So in this regard, I'm a bad accountant, because I never remember the name of the person who created double entry bookkeeping. But you're right. It was an Italian merchant. I'm going to say like 14 or 1500s. It goes way back. And just like you, I'm fascinated by it. For whatever reason, I think it's one of the coolest things out there. But you're right. It's imperfect. And when I go through the adjustments that I make in a lot of ways, I know why. I'll pick on the Financial Accounting Standards Board, since I'm U.S. based, right? I know why FASB classifies things the way that they do. They're consistent. There's nothing wrong with it. but it's the analyst or the investor's job to make adjustments to get at the true earnings potential of the business, or the true cash flow generating capability of the business. And so in no way, shape, or form do I think the regulators are doing anything wrong. I think it's just the analysts that are, I don't know if they're being lazy or or what it is. But so to me, that's high level how I think about it. But as far as kind of how they came about, it's really, I mean, I wish I understood the history behind it more. All I know is by teaching it, it makes perfect sense to me why things flow together the way that they do, right? The income statement filters through the balance sheet. Both of those act as a filter for the statement of cash flows.
Yeah.
And so I don't know, to me, I just think it was part genius how it came about. And I know I'm not giving a direct answer to your question, so feel free to ask it again.
No, I think it's eye-opening to realize that they're not set in stone.
Right.
There's not a page in the Bible or any other document, holy document, that says this is the balance sheet. No, it's evolved and changed. Even in my professional lifetime, we move things around. Stock-based compensation. You mentioned leases. I can think of a few more things that we just changed how we account for them, and companies started to report them in a different way. And some of those things, and we'll talk about stock-based compensation, we don't have the best method yet to capture the economic reality. And none other than Buffett himself, he would talk about it, how, well, they follow the rules, they report the way it is, and then they say, to be honest with you, this is the reality we see, the actual economic reality. And obviously that reality, sometimes the way he reports it makes him look worse, but it's a more honest account of how things are, you know. It is an actual expense. I don't want to hide it anywhere and wait to depreciate it, amortize it. It is an expense and it's costing me money, and he's showing it. And I think more CEOs could think about it that way. But one quick thought about the double entry. The way I find it, fascinating, it's a very honest system. Like, the transaction cannot happen unless you have the twin, like there's no transaction that can happen. And I think it's a wonderful way of looking at it. If you spend the cash, then you're adding inventory. If your inventory goes down because you sold it, the cash comes back. Just a simple example, right? Like, there's always a twin, and you have to know where the twin goes. I don't know, the way it was shown to me by an old accountant in my accounting course, just the light bulb went on, and I thought, I can't see the world any other way.
No, I was the exact same way. Once you learn that, and the example you're using, particularly with sales and inventory, it's just, and when I used to teach intro accounting many years ago, I would always tell people, guys, here's your trick. Most of the time it's maybe 2 entries, but when you sell something, it's probably 4 entries, because don't forget, you have to account for the inventory leaving. Yeah. And I used to get, this was true when I was an undergraduate, and it was true when I taught undergraduates. There's a lot of people who miss that. And so that usually helps set the curve on the exam, because half the class is not going to remember that rule.
But it's worth asking and worth remembering. You're right. It's multiple transactions, but they always have a friend, a twin.
Yep.
I want to ask you about stock-based compensation. I mean, on the surface, such a wonderful idea. We're going to make people owners of the business. I think you and I can agree that it's a good idea to have employees feel like they're invested in the business. But there are some consequences that happen. And I think we are still having a hard time analyzing, understanding, and grasping what kind of an impact that phenomenon has. One last thing. More companies are using stock-based compensation. I think they have to use it to attract the talent. So I don't think it's going away. We have to learn to live with it. I think some companies overdo it. As a shareholder, I feel that way. But what are your thoughts? Why is it so hard to grasp the actual economic impact on the business and on us as participants in it, stakeholders and shareholders?
So I'm going to give you a long answer, so I apologize in advance, because I spent 3 years of my life trying to figure this out, and then I eventually figured it out. So years ago, I want to say this was in the late 90s, I read an interview from that time with Buffett and Munger, and I know it was Munger who said, we try to adjust for the true cost of stock-based compensation. Now, at that time in the late 90s, all that was required was a footnote that said, hey, if we actually accounted for this as an expense, this is what it would do. It was just a footnote where it was like, well, I know we reported $1.50 in earnings per share, but it would really be $1.25 if we actually accounted for this as an expense. Okay. Well, Buffett and Munger said, that's still not right. So we're going to try to account for this properly. And for years, it always bothered me, well, what does that mean? But I was too young and too inexperienced to really understand how any of this worked. So probably 10 years ago now, I really started to dig into this because it just bothered me that I knew my forecasts for the investments I was picking were still wrong because I didn't understand this topic. So I'm digging through annual reports, and it's like anything else. The knowledge is cumulative. So you might not find the answer just in a book somewhere, and trust me, you won't. Not on this, I've looked. But if you just keep looking, companies are going to present things differently, and sooner or later you'll figure it out. And that's exactly what happened. So I started talking to, once I figured it out, and I'm a former mergers and acquisitions analyst. I did investment banking, so we didn't do it then either. But I started talking to audit partners, tax partners. I called a couple of Fortune 50 CFOs, then a couple of CEOs, and they all said the same thing. I didn't even understand how these things worked until I actually started receiving them, which means they were in the C-suite. And I thought, you got to be kidding me. So when I finally figured this out, I spoke to a friend of mine who used to be the CEO of the North American division for a very large pharma company. And I asked her, and I said, doesn't this mean the internal budgets are wrong? She said, yeah. I said, oh my God. She goes, yeah, it's challenging. She goes, now the people in Treasury understand this because they're the ones actually dealing with the cash. But the main issue is a lot of the people analyzing these things don't receive any stock-based compensation. So they don't really, I've learned, understand how it works. They don't understand the mechanics. And then the regulators, whether rightly or wrongly, use a model, the Black-Scholes, to estimate what the cost of this will be. And that's it. It's almost like it's been outsourced to say, well, these guys won a Nobel Prize for this, so it's got to be pretty good. And it's like, well, it's not bad. It's better than nothing.
Sure.
But it's still not accurate. And what's amazing is that if you know how to go through the annual reports and the footnotes, you can get the exact number. It's there. You have to do some mathematical calisthenics to get there, but the data is there. And I have not met one person yet, including some of the folks that you and I now know well because of the stuff that we get to go to, that understand this. And so last year at the conference, I was actually kind of taking a quasi poll of the room, just saying, would this be something you'd want to learn more about? And people said, yeah, absolutely. Because there is a drastic misfire. Now, for most companies, it's not a big deal.
Sure.
But for companies in the tech sector, there's large companies that some of the biggest in the world that I've looked at it, and I look at it and I say their free cash flow is 30 to 40% lower what everybody thinks it is. And so if you invert that, then you realize, okay, well then that means that the stock is like more than 50%. Or the valuation on the stock is 50% higher than what we think it is, simply because we're not accounting for this properly. And it's not that anybody's doing anything wrong. It's not fraudulent. It's that the analysts are not making the proper adjustments. I know fully well why FASB has it classified the way that they do. It makes sense. But this is the analyst's job, is to figure it out. And I don't know if I'm right in the sense that this is what Buffett and Munger do. I just know that was the motivating piece for me when they said 25 years ago, no, we try to adjust for it the right way. No one's ever really pushed them on that to say, what does that mean? And there's no textbook that I'm aware of that does it right. That's why I don't use one. And I tell my class that every fall when I teach, I say this is the main reason we don't use one, because they just gloss over it. And on the statement of cash flows, we just add back the expense used under GAAP or IFRS. I'm like, that's it. And I'm sitting there thinking, yeah, but there's a cash impact to this. Why aren't we talking about that?
Can you walk us through this dynamic these days, the practice today, right? So the stock-based compensation happens. It's an expense. It's added back in the cash flow statement. We're doing it today for this year.
Yep.
But
So
it vests over time. So we don't really know the actual end cost of what we just decided to do as a company, right?
yes. So this is multi-layer and multi-situational. And what I mean by that is that this is not like converting LIFO to FIFO inventory where you kind of do it one way and like that's it.
Yeah.
This is a true it depends model. And it depends on what kind of stock-based comp are they using. Are they using stock options or are they using restricted stock and performance stock? Because under one scenario, the stock options, the company will receive cash. Now you have to account for that. In the RSU, PSU example, for the most part, the company doesn't receive cash. Maybe sometimes, but not often. So right there's one main difference. Then the question is, does the company have a buyback or not? So again, not an endorsement by any stretch of the imagination. This is literally in their 10Ks. But Microsoft, Johnson & Johnson, companies like that will say the following. We, at a minimum, will repurchase enough stock to offset dilution from stock-based compensation. Well, then right there, this becomes a cash outflow to the business.
Yes, it does.
No different than the CEO's salary or bonus. It's a cash outflow. But that outflow for stock-based compensation is not listed as an operating activity on the statement of cash flows. It's listed as a financing activity.
It is.
On the income statement, it's even more funny because this I cannot believe, but you use the Black-Scholes model, you come up with an expense. Fine. Let's just say it's $300,000. Fine. Book the expense. All right. That's probably going to come out of mostly of SG&A. Okay, great. And then, so it's lowered our operating income, it's lowered our net income. Then the dilution from actually granting the shares shows up in the diluted share count. So our diluted earnings per share was just hit twice. It's the only expense I know of that does that. It actually hits it twice. This to me is why most companies, correctly in my opinion, actually add back stock-based compensation to come up with adjusted EBITDA or adjusted net income, because there's no reason to double hit earnings per share. And that's exactly what GAAP is requiring it to do. The dilution is still there, whether you like it or not. So there's no reason to adjust for that. The shares, they were issued, they're active, or even if they're not live yet, they're in the diluted share count, right, for potential conversion later on. So fine. Where this gets tricky, though, is, well, was there a cash inflow net or was there a cash outflow net? And that's what's not accounted for on the income statement. So what I do is I will actually go through the footnotes and say, okay, what was the inflow, if any? What was the outflow, if any? And that's the amount that I put on my income statement when I'm trying to figure out what was the real cost of this thing.
Right.
Because let's just say, for argument's sake, that the company issued 1,000 stock options. Fine. That shows up in the diluted EPS. But if there's a buyback, well, then it doesn't show up in the diluted share count because they bought the shares back.
Right.
But they certainly spent money. So why isn't that a SG&A?
Yes.
Why isn't that OpEx? And nobody does it. I'm not kidding when I tell you, like I said, I've done this with CFOs. There was one CFO, he had just stepped down from a Fortune 100. I walked him through this and he honestly said, he goes, I don't think I'm smart enough to understand this. Now, maybe he was just trying to get off the call. That's fine. But that's a very interesting way of putting it. And like I said, I've done this with comp experts. I've back tested this thing every way possible, and everyone says the same thing. I've never thought of it this way. There's actually an audit partner out of one of the big four. He's a friend of mine. And I asked him one time, I said, who's your subject matter expert? Who's your SME on stock-based comp? And he goes, I am. So I'm on the call with them, and I could tell at one point I was put on speaker. So I go through my spiel. 2 months later, we're at a dinner together, and I said, hey, pal, was I on speaker? And he goes, yeah. I said, why'd you do that? And he said, I wanted my team to hear that because we've never thought of this. And I'm just sitting there thinking, yeah, nobody has. If I ever see a sell-side analyst report that has it, I'll send it to you. But I have never seen one that adjusts for it.
I hope there will be a day. As I'm listening to you, I have two thoughts. One, we could just ban it, say it's not allowed, which is unlikely. And the second thing, we have to learn to live with it. You have a magic wand. How would you go about changing how we report it, how companies are required to report it? so that we have a more honest and direct way of understanding what is actually happening between the expenses, what's happening on the balance in the cash flow statement, and the share count, which is a moving target here.
So I'm going to answer this for the first time during this interview, and I rarely do this, but I'm going to answer this not as an investor, but as an academic. And the reason for that is because I know the accounting rules. I've been to the FASB. I've been through their board meetings and whatnot. I actually wouldn't change anything on the reporting because I know why they're doing it the way that they do it. It makes sense because when you issue shares, whether to investors or to your employees, that essentially is a financing activity.
It is.
I wouldn't want to treat it as an operating activity because now you get into too much. Well, when is it operating? When is it financing? Or when is it investing? And now you got to come up with a list of exceptions, and I don't want to do that.
Simple.
What I think needs to be done is that there needs to be more discussion so analysts better understand, hey, this is what this means. And so it's up to you, but you might want to consider this more as an operating instead of a financing activity. Or you might want to consider this as part of SG&A, not just a simple add back to come up with adjusted EBITDA. So this is why I always say, I tell my classes, and I know I've said it on this call, I don't think FASB is doing anything wrong. I don't think companies are doing anything wrong. I think analysts and investors need to do a better job of educating themselves about this issue so they can make the proper adjustments. And FASB is very clear on this, right? As most CFOs will say, it is our job to follow the rules and report accordingly. It is the user's responsibility to understand the rules so they can make whatever adjustments they feel necessary. And to me, that makes perfect sense. So I just want to be clear on that. I don't think any regulator or any company is doing something they shouldn't be doing. I just think if anything, investors need to be better educated on this. Where I do think there's an issue, like I said, the textbooks I've seen, all they say is, well, this is what happens when we issue shares. We use Black-Scholes, book the expense, and we're done. And I'm sitting there like, that's it? there's nothing else? Because in some cases, like we said, in tech industry particularly, this could be a very large number. It could be 30. I've seen it at 30-40% of free cash flow.
I've seen it in companies that don't have substantial profit that issue more share. Yeah, the stock-based compensation is higher than the profit, but that's
yeah.
But I'm glad you're presenting it this way. You're basically saying, here are the statements, here are the rules, and if you want to analyze the business, give it a lot more thought because there's more to this particular phenomenon. It's much more complex than any other simple transaction where you sell something, inventory goes down, you book it, it's done. Here it's much more complex, and it's spread out in time as well because you don't know when those things, well, you do know, but you have to look when they vest. You don't know at what price, if they're doing buybacks to offset it, they will actually have to buy those shares.
Yes.
It's, I think we're going to continue to learn to live with it. And I think the managements will maybe think about it a bit more, how they go about it, because it's a very open-ended commitment. And maybe it's easier to just pay somebody more today, be done with it. But that's wishful thinking.
Well, and I agree that stock-based comp is a good thing to do for your employees and things like that. I mean, where it goes off the rails is when we set improper targets. If the targets are too short term, right? Like we just tell our sales team, hey, we'll give you a stock-based comp, but just go out there and increase sales with no regard to profitability. Well, that's silly. That's not a good idea. But if the targets that we're using are well thought out and have the shareholders' best interest in mind and whatnot, then to me, it's like, yeah, give away shares. It's fine. I did this with a friend of mine. He's the chief technology officer of a very large company. He'd just gotten promoted to CTO. This was like 18 months ago. And I walked him through it with his company. And he started doing this. He goes, oh my God. I said, what's the problem? He said, well, I think I have to go report this to the board. And I said, no. I said, I didn't say you're doing anything wrong. I'm just telling you that if an analyst ever sees this and asks you about it, you might want to have a good answer. And that was the end of it. Now, for that particular company, it doesn't even impact their free cash flow by 5%. It's immaterial. So again, this is highly situational, but this is why you need to know your companies well and how they handle this stuff, because in some cases it can be significant.
You touched on something that I'm very intrigued about, because it's an incentive, and I think the whole world goes around because of incentives, and we can use some incentives in a way that's better or worse, wiser or more efficient, however you want to look at it. But people might not be prepared to receive that kind of compensation. Can you talk about that aspect, which links back to your teaching people how the money works on a personal level? They receive it, they don't know in how many years. It's a bit overwhelming.
So we're tap dancing on a volcano in a good way. So I do this with every client. I will study their retirement plans and see if they're taking advantage of certain benefits or not that exist that most people don't know exist. And there's statistics on that. This isn't me making it up. I mean, there's articles that'll say like, well, less than 10% of companies use this retirement benefit that exists. And I talk to them and they just say, we didn't even know it existed. When I do this with executives and I'll talk to them about their share-based plans, they all say the same thing. We have no idea how these things work. Hence the CFOs have told me, like, we never knew how they worked until we became CFOs, because we just didn't get them. So why would we pay attention to them?
Right.
So there is a drastic misunderstanding with how these plans work. And people will often say, well, this is HR's fault. And I say, no, it's not. It's not HR's fault. Here's what a lot of HR groups have told me. We don't want to go too far with this because we are not financial advisors. We are not licensed to give this kind of information. So we don't. And I say, that's cool. I actually feel bad for HR in this regard because it is a benefit. And so like every benefit, it falls in HR's bucket, but they are not trained to explain it. So a lot of times I'll come in and explain it because I am licensed. And I don't have a 7 or 66. I don't sell products. I just have a 65 because for analytical purposes, I set up an investment advisory, but I don't sell anything. It's all educational, so to speak. And the regulator kind of insisted that I go set it up, but you don't need a 7 or 66. Okay. So I can talk about this stuff and not feel that I'm at risk of doing something wrong. Where HR, they don't have these licenses. So they get the documents, the employees, they're written by lawyers. And unless you're a lawyer, you're not going to understand them. I don't have the time. So, but people just don't get the training. They don't get a fair understanding of the mechanics of how these things work and how they can benefit from them. And therefore they just don't understand it. And I've seen this at every client. I did this with a client 2 months ago. I was on site with them and they had just rolled out this thing with their 401k. I was talking to their North American CFO and I said, do you guys offer this? He goes, I honestly don't know. And so he showed me his 401k plan. I said, yeah, you do. It's right there. It's that. And he goes, oh. So he called down the head of benefits. We had lunch together and they had just rolled it out January 1st, 2025. So I said, well, can I go tell the group this? And they said, yeah. And it's the same reaction every time. Why, how come we haven't heard about this? I didn't know about this. And like half the room was on the phone with their financial advisors by the end of the day trying to like, hey, can we take advantage of this? And it's like, yes, you can. Just go call your FA and set it up. But here's what you need to do. I actually had one guy, a chief operating officer. He just switched companies. He sent me his 401k documents mid-flight. He was in the air and he sent them to me and he goes, can you look at, like, he just took a screenshot and sent it to me. And he goes, can you tell me what we're doing? I said, yeah, you're doing it here. This is what you need to do. Just call your plan administrator and do this. And like, that was it. But at HR, most of the time they're scared out of their minds. They don't want to touch it because if they do give it any advice, then what's going to happen is they get inundated with phone calls. What do I do? What do I do? And at this point, they're giving financial advice. So this is kind of a weird quirk, I think, in the way the rules are written, that it's like, well, the people you should ask, you can't because they're not licensed, but they're the ones who set up the plan.
You need outside help to navigate this territory. I have a lot of questions, but one I don't want to miss. You basically shared with me that what we call free cash flow is not free cash flow. And you kind of hinted throughout this conversation how that works. But a lot of value investors are looking, beyond EBITDA. They say, well, the free cash flow is that. But you're telling me that it's not. There's more to it. Can you share how that works?
So when I look at a reconciliation of EBITDA to free cash flow, and European companies are really good at this. They're really good at providing this. The things that get missed, the big three, as I call them, are pensions, leases, and stock-based compensation. Not in any order of magnitude. If I had to put it in order of magnitude, I'd probably reverse that. Stock-based comp would be the biggest. EBITDA, same thing, right? I mean, EBITDA is a silly measure of cash flow because, well, we do have interest that we're paying.
Yes.
Last I checked, the government wants their money, so there's that. And then, of course, depreciation amortization is CapEx. But, I mean, there's no adjustment even for net working capital. So while some investors are doing that, and that's fine, and they say, see, I can get to the GAAP or IFRS free cash flow, all I say is, congratulations, you still haven't adjusted for the big three I just mentioned. And so if your pension is underfunded, or overfunded, let's say it's overfunded, right? If we're lucky enough to have an overfunded pension, then we're just not making pension contributions. So that makes our cash from ops be higher than it would be otherwise. If it's an operating lease, everything shows up in cash from operations. If it's a financing lease, the principal payment does not, only the interest payment does. And if it is a stock-based compensation, if it's stock options, the cash inflow is not an operating activity. If there's a buyback, that's not an operating activity. And I would argue that they need to be, because if we're paying our CEO in cash and bonus and that's operations, then by all means, so is our stock-based comp. Yeah. So those are the big three to me. Now, it used to be that the cash taxes that companies would pay for stock-based compensation also wasn't a operating activity. But I want to say in 2017 that changed. FASB had been kicking it around for years, and in 2017 was the first year that they moved that line item from financing to an operating activity. And that was funny because in the U.S. that was an election year, and everybody was running around saying that this had something to do with politics. And it's like, no, FASB had been working on that for like 4 years. And it was just a reclassification. That's all it was. The amount of cash the company was taking in did not change. It was just the classification changed. So those are kind of the big three, really. And in some cases, they can be hugely significant. I'm analyzing a retailer right now where their rent expenses, I want to say it's 20% of SG&A.
No, it's very helpful because we think that those numbers that we work with, they're kind of fixed and the same number for everyone. You're using the same statements as everybody else, but how you go about it, it can be different, and how deep you go. And you're doing an incredible job both analyzing and explaining how those things talk to each other or don't talk to each other. What are the consequences. And I think it's very, very helpful. I don't read sell-side reports, and I haven't read in many years. I feel like they're too focused on earnings per share, and they don't even look at the balance sheet. And so I feel like it's just not helpful. And so but I know that some people still, read those, and they're very smart people writing them. I think their mandates are very limited to what's asked of them, and that's what they deliver. I think, speaking of incentives, so no, I know very smart people on the sell side too. But the point is, if you're doing that kind of research for your own benefit, if you're managing money or your own money, other people's money, there's a lot more things that you could look at and analyze because the information is out there. How we interact with it, I think that's a whole different thing. Kevin, I could keep you here all day. I have one last question. Yeah. How do you think about success?
Ooh, great question. So with where I am in my career right now, I'm trying to do two things predominantly, is continue to grow my consulting practice and, of course, the investment advisory, the deep dives that we talked about. How I think about success is I have a couple of long-term goals I have in mind. My wife and I have in mind, both monetary and non-monetary. And so obviously we'd like to achieve those. But in the last 4 years, especially that I've been consulting, and the investment advisory is very new. It's only like 2 months old. The commonality in both is, and I alluded to this earlier, when somebody tells me, I never thought of my job this way. Or when an investor tells me, you and I have mutual friends that we've met at various places that I've shown some of this stuff to, and they just say, "Oh my God, I can't unsee this," and now I feel like I'm a better investor.
Yes.
That really is what I'm going for. I'm either through my investment advisory trying to make people better investors, and through my consulting make them better employees, so they incrementally add value to the corporation's capital allocation responsibilities, if you will, and help them find their purpose. So what I like to tell people is I help them understand the why their job is important to the organization from a financial standpoint, because everybody wants to feel like they're a part of something. In my experience, 99% of the people out there want to feel that they really do make a difference. And so I'm trying to show them that. And either by making them a better investor or making them just a better capital allocator for their business. That to me is success. If I could fill my year doing that, then I'll feel that I've attained the level of success that I want to. And because I know what I charge, that'll help me get to the monetary goals that my wife and I have laid out. But it's very direct, and it's very much just about doing. I want to make sure that I do something, not be something, so to speak, if that makes sense.
No, I love the sound of it. I know that you love what you do and you're very passionate about it. You're opening our eyes at all levels, from an individual that's trying to figure out household, money, finances, all the way to the CEO and everything in between, because it's all connected. The CEO's decision to give somebody stock-based compensation affects the household situation and dynamics and tax planning and maybe estate planning and more. So there's a lot. It's all connected. It doesn't exist in a vacuum. And
exactly right.
You have a beautiful way of traveling up and down, left to right, across this universe between personal accounting all the way to business accounting and everything in between. And I really appreciate you sharing this knowledge with me and my audience. And I'm hoping it inspired some more questions that people will follow up with and see things differently. You know, it's like the accounting principles. Once you start to understand them, you can't see the world in any other way. And here with this conversation, I think nobody can look at stock-based compensation without thinking about what we discussed. You know, there's more to it than what you immediately see on the statement.
Exactly right. That certainly is the hope, that people look at it just a little differently.
That's the hope. Kevin, thank you so much for today. What a joy to have you on the show.
Now, Bogan, truly my pleasure. Thank you for having me.
You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski.